There is an invisible market worth over $100 trillion that dictates your mortgage rate, your job security, and the price of your investments. Most assume it's the stock market. Others point to Bitcoin. Neither is the actual driver. The global financial system actually runs on the bond market. At its simplest, a bond is just a loan. If you start a business and need capital, you borrow from someone who has it. You promise to pay them back the original amount plus a little extra for the trouble. That extra is the interest. This agreement relies on 4 variables. The principal is the borrowed amount. The maturity is the due date. The coupon is the fixed annual interest percentage. And the yield is the investor's actual return based on the current price. While companies borrow this way to grow, the entire system is anchored by the largest and most frequent borrowers in history, national governments. Governments spend billions on infrastructure, military defense, and healthcare. Because they routinely spend more than they collect in taxes, they run what is called a budget deficit. To bridge that gap, the Treasury issues sovereign bonds. They are essentially borrowing directly from the global public to fund the state. This borrowing adds to the national debt every year. As of 2025, the UK owes $2.7 trillion. The United States national debt is significantly larger, standing at $36.7 trillion. Investors view U.S. government bonds as the safest place to put money because the government has a long history of meeting its obligations. This perceived safety makes these bonds the bedrock of global finance. If the U.S. were to default, investors would lose the primary anchor used to value almost every other asset. Because these bonds carry virtually no risk of default, the interest rate they pay becomes the risk-free rate, the baseline for all other global lending. This baseline is set in the primary market. The Treasury holds regular auctions where banks, pension funds, and foreign nations bid on new debt. Once issued, those bonds enter the secondary market. Here, they are bought and sold daily as investors react to the news. If they think inflation will rise or the economy will slow down, they adjust the price they are willing to pay. This creates the most important rule in the market. While the coupon is fixed, the trading price changes. When a bond's price falls, its yield rises in a permanent inverse relationship. The collective yield demanded by investors becomes the market interest rate, reflecting the world's consensus on what money should cost. This macro bidding war is what determines the interest rate on your personal credit card or the 30-year mortgage on your home. Government bonds offer a guaranteed return, but stocks are a piece of ownership in a private company. If that company's profits drop or it goes bankrupt, the stock price can fall to zero. To compensate for danger, investors demand higher returns from stocks than safe bonds. This gap is the equity risk premium. When bond yields rise, this premium shrinks. The extra reward no longer justifies the risk, so investors move their money back into bonds. You can see this same tension in the high-yield spread. This measures the difference in interest rates between safe government debt and the riskier bonds issued by private corporations. This spread acts as a market alarm. When it widens, it means investors are terrified of corporate defaults and are demanding massive interest payments to take the risk. Rising market rates create a direct problem for the borrower. As the yield demanded by the market goes up, the cost for the government to borrow more money rises with it. Much of the national debt is held in short-term bills that mature quickly. To pay these off, the government rolls over the debt by issuing new bonds. If interest rates have risen since the last auction, the government is forced to replace cheap old debt with expensive new debt. This creates a heavy financial burden. The U.S. government currently pays out roughly $3 billion every single day in interest alone, just to service the debt it already has. Every dollar spent on these interest payments is a dollar taken away from public services. It drains the GDP, leaving less for healthcare, education, and infrastructure projects. To maintain those services while paying the interest, the government is forced to borrow even more. This compounds the total debt, ensuring that future interest payments will be even higher. The bond market acts as the heavy gravity of the financial world, exerting an active force on every sector of the economy. When government debt service costs climb, the state has less to invest in growth. To fund the DAP, the government competes with private businesses for the same pool of capital, which pushes interest rates higher for everyone. This cycle eventually starves the private sector of investment, causing the entire economic machine to grind toward a halt. Understanding bonds is the key to understanding how money actually moves through our world. If you found this breakdown helpful, like the video, and subscribe for more. Thanks for watching.